Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. Here's the secret, folks. A guy asked me, a wonderful guy emailed me this weekend. He said, how in God's name do you do it? And the answer is you read. And I learned decades ago that if you read anything from Routledge Press, you will be happy. It is an esteemed British firm. This little jewel, 165 pages came in. This should be in the CFA curricula immediately. He's with Federated Hermes. He has to put up with Steve Oth. Daniel Peris joins us, historian, PhD, and this is about what Paul Sweeney cares about more than anything, the ownership dividend. It is a magnificent global Wall Street primer on dividends. Daniel Peris, thank you so much for joining us today. You have the Paul Sweeney page, which is Cliff Asness at AQR saying, we've done the work. Don't worry about paying taxes on dividends. Dividends are good. What does that mean for our listeners, our viewers?
You know, Tom, thank you for having me on the show. The way I phrase it a little bit differently is that in my day job, I do run into a lot of advisors and clients who really want to subordinate investment policy to tax minimization. It seems to be more important to them than the investment policy. And I make the simple statement, that's a choice, not a necessity. Academic finance is really strong on tax minimization. There's nothing wrong with that. But I take a stand as a business owner that investment policy should not be subordinated to tax minimization policy. And while the tax code is often adverse, you know, it's a sign of success or victory if you find yourself having to pay a bit. So it's one of the biggest issues I run into on a daily basis. Page
53, Philip Fisher. There was the Old Testament, the New Testament, and then there was common stocks and uncommon profits. A million, like a generation ago. Daniel Peris, should Apple raise their dividend?
Yeah, the biggest pushback I get from this book, and Apple's a perfect example of that, is, listen, buybacks are fine. And I don't dispute the utility of buybacks in certain circumstances, not how they're widely used. But I'm challenged and said, well, you know, where would these dividends come from? We don't want to starve companies of growth opportunities. And of course we don't. Companies should invest in positive NPV projects. But when there's close to $1 trillion spent from the S&P 500 companies, notably concentrated in a handful of very large tech companies, on buybacks, shifting some of that over time, which I believe will happen as interest rates have stopped falling, is not going to come at the expense of investment and growth. It's going to come out of the buybacks. And Apple and many of the other companies that say they can't afford to pay a dividend because they've got so many good growth projects are also buying their shares back hand over fist. Looks good in a rising market. They need to do so when they're issuing shares out the back door to employees. But the payout ratio for the large tech companies, which is currently pretty low, and for, well, let's call it the NASDAQ 100, whether they're in the NASDAQ 100 or not. But I'm just talking about the large, mature tech companies. I believe over the next couple years, over the next 5 to 10 years, you're going to see many of them follow in the footsteps of Meta and others.
There you go, Paul.
And go down that path.
Yep. There we go. So, Daniel, is there an ideal payout ratio? What does the academic research say?
You just stepped on an academic landmine. I don't know if we want to go there. In 1961, the issue of whether there's an ideal payout ratio was raised and answered definitively. So the answer is no, and I don't dispute that finding from 1961. Though much of my work is historically critical of academic finance, of modern academic finance. Some would say very critical. But in the book, I do argue that, listen, I don't know what the payout ratio is going to be and the yield of the S&P 500 is going to be. I just know it's going to be higher than it is now. We've had a 30-year anomaly of declining yields, declining payout ratios, rising buybacks, and other phenomena, which I think, as the book articulates, kind of came to an end starting in 2020. And is the yield of the S&P 500 ready? Is everyone sitting down? Is it going to be 3%, 4%, 4.5%? I don't know.
But Paul, I'm going to pay
I think it's going to normalize in that
on
direction.
If Lucas was here from Apple, he'd say all of our research is shareholders don't want to pay tax on that 4% SPX dividend.
So what do you say to that, Daniel, about the tax implications here? What's the counter argument, I guess, if there is one?
Yeah, the only difference right now, remember, long-term capital gains and qualified dividends are taxed at the same rate. Okay. So from a purely investment perspective, there's no penalty. When modern academic finance and when that Apple executive was being trained, tax rates were higher on dividends than they were on capital gains. That's no longer the case and hasn't been since 2003. The only difference is timing. So that a investor can time a capital gain or capital loss. Again, investors can harvest capital losses as easily as they can harvest capital gains, but an investor can time that, whereas a dividend occurs more regularly. My answer, and it's really the theme of the book, and it's in the title, and you caught it, Tom, is a harvested capital gain is a market outcome for which many, many people, when the market moves up and to the right, are very happy with. A dividend payment is a business outcome. You can choose to play the market or you can choose to be a business owner. Now, there are a lot of young people in particular who don't care about being a business owner. They just think of stocks, buy low, sell high, repeat frequently, it goes up to the right. And that's fine. There's nothing wrong with them. That kind of a clientele effect. There are a lot of people very satisfied with that. I'm just pointing that if you bring a business owner sensibility to stocks, the same way you might to real estate or a private enterprise, you view a harvested capital gain as something dramatically different from a dividend payment.
I got 1 minute left, Daniel. Peris. Is Zuckerberg the executive of the year because he turned gear here and just simply said, no, we're going to change this. We're going to do this like a conservative, measured company?
I just think he's a quick reader. So the book came out one day, and the very next day, Meta made its decision. So I applaud him for reading, getting a copy and reading it quickly.
Daniel, thank you so much. He's the Federated Hermes, but I just can't say enough about the history of this. Folks, this goes back to my grandparents. It's that strong. It's got M&M in it, Merton and Modigliani, all sorts of theories. Zvi Bodhi, if you're listening up at BU this morning, your great corporate team, this is a book for you. The Ownership Dividend, it's a pro book, folks. I'm not going to kid you. Lots of footnotes, lots of what you'd expect in an academic's treatise from the PhD historian. Daniel Peris, The Ownership Dividend, the coming paradigm shift is the stock market catches up with Paul Sweeney.
Exactly.
That's a good. Paul, take that book.
I'm taking
read it.
I'm going to give it to Mr. Tim Cook when I see him this spring on the campus of Duke University.
This is the conversation of the day, flat out. I'm going to say, we're going to talk to Sarah Rappaport about Queen in the next hour. This is, without question, the conversation of the day. Patrick Armstrong believes in the frenzy. He says it's not a frenzy, and you got to own Amazon the rest. Yep. And what date matters? Here's the date that matters. Mark it on your surveillance calendar. May 24th, NVIDIA reports again. Patrick Armstrong, why do you own NVIDIA?
Well, it's obviously a great company. It's the epicenter of everything that's AI, and it's not trading at a ridiculous multiple. Stock is up 400% over the last 14 months. Earnings are up over 1,000% over that time. It's at 32 times 12-month forward earnings, 26 times 24 months forward. So elevated multiple, great company, incredible margins, and it can produce as much as there is demand for its product. So I love companies with pricing power that basically set the price, and people are clamoring to get whatever they can from whatever it produces.
Over the weekend, and thanks, shout out to Zero Hedge, who does a great service on this. They have the Goldman Sachs hedge fund buy side, long only, long short report. It's absolutely spectacular. Thank you for that service. And Patrick, it's simple. In the last X number of days, institutions have sold what Patrick Armstrong owns, and retail is bought what Patrick Armstrong owns. What's that signal to you?
I don't know if it's a strong signal either way, but you always have an instinct to take profits on something that's gone up so much. But I just look at the valuations versus the price, and valuations aren't rising. It's the price that's rising for NVIDIA. So I'm sticking with it right now. You've got the earnings in May that you just referenced, but in March, the middle of March, they're coming out with their next generation chip, what that's capable of as well. And I think that's going to be a really important date, that you don't schedule that ahead after incredible blowout earnings unless you know you're going to really shock the market again and just basically create that momentum that everyone's clamoring for on the retail side of things. But it's not a 2000 type bubble.
Right.
It's maybe the estimates are too high. That's a possibility. Basically, if another company comes in with a competing chip and then NVIDIA all of a sudden has to compete on price, they don't have to compete on price right now. But it's not a multiple story. It may be over-optimistic earnings estimates, but I actually believe those estimates.
Listening to Patrick Armstrong, Neil Dutta at Renmac. Thank you, Neil, for getting off the Delta airplane. And Neil says it's simple. Consensus is wrong. He agrees with the optimistic tone that we hear from Mr. Armstrong.
So, Patrick, in addition to NVIDIA, how do you feel about those other, big cap, magnificent 5-6 names, whether it's the Amazons, the Googles, the Metas? Do you have a similar level of conviction to remain long those names here?
So I own Google, I own Meta, and those are companies that aren't trading at demanding multiples. They're trading at discounts to the NASDAQ, trading almost in line with the S&P, but they're growing at a faster rate. They're buying back shares at a faster rate, still producing a lot of free cash flow. You've got a lot of advertising risk with that, but you've got an incredibly resilient consumer, and I think advertising is going to continue to drive revenue growth for those companies. So I own both of those. I own Amazon as well, which is, again, a play on the U.S. consumer that's just very strong.
All right, so
Dow component.
I know. Exactly. Dow, you're exactly right, Tom. Dow component today. All right, so Patrick, you and Tom, you're both long the big tech names that have been working. Both of you guys are just clipping coupons. The rest of us are out there working for our money here. How about energy? What do you feel about energy? I'm looking at WTI crude here. It's $76 a barrel. How are you thinking about the energy space?
I like the oil and gas companies for a number of reasons. I think you get an inbuilt geopolitical hedge against unfortunate events that might be happening in the Middle East or with Russia or the war expanding in the Middle East where more sanctions come on Iran, things like that. But if you look at the futures strip, spot prices for WTI are the same as they were 6 months ago and 12 months ago. But the longer dated contracts are up 30% over that time. So oil and gas stocks are flat over the last 12 months, but their implied profitability based on the futures strip going out the next 10 years, that part of the curve has really jumped higher. And I think the companies aren't really reflecting that higher for longer crude prices. And I do think they'll start to move that way.
So it's interesting here because we're looking at, the supply and demand out there for energy. And again, I'm not sure what's driving this thing. Is it the supply side of the equation or the demand side of the equation? But I guess if you feel like the economies in the U.S. are going to remain strong, that would suggest maybe higher oil. Is that how you think about it?
I'm not sure if it's going to be higher, but the bull case on oil and gas companies don't need higher oil. They need oil to maintain these prices because right now the cash flows they're producing are incredible, and they've paid off a big chunk of debt over the last 12 months. They've bought back shares, paying dividends as well, and all of those things are boring compared to the technology companies, but the market is going to re-rate as you see persistently high crude prices based on growing demand and supply not quite keeping up, basically. There's not been enough CapEx to probably deliver the new supply that's going to be needed to meet demand.
What shorts have been working for you guys, Patrick?
So you talked about the auto companies. We're short Rivian, we're short Ford, and yeah, I love companies that have pricing power. I hate companies that are market takers of price. And unfortunately, if you're an EV producer, there's still demand for what you're producing, but you've really got to compete on price.
But the truck looks really cool, though.
Incredible products, but
I've yet to see a positive review.
Seriously.
Yeah. I mean, Lisa took one for a test drive this weekend. Lisa, what do you think of the Tesla, the car? The cyber thing.
The cyber thing?
Yeah. What would you
feel like you're out of a version of Mad Max.
No, we're not done with Patrick. We're just going to Lisa to talk, Cybertruck and all that. Patrick, I want to ask you a pro question. You got your own Plurimi Capital now. What would you do as a portfolio manager if they said, Patrick, you own 13% in Meta, you own 10% in Amazon, you got to lighten up based on prospectus? How would you respond to that?
Well, in our UCITS funds, we do have those restrictions. In Europe, there's a 5-10-40 rule, meaning you can only have 10% in one position. But with global mandates, that's more than enough for me anyway. In a U.S.-centric mandate, you might start to feel constrained by those kind of things. I'm happy to run in a global mandate less than 10% in those kind of stocks. So I don't want my portfolios to be one stock bets. A client can do that themselves, but we manage a 30-stock portfolio. So that's not a constraint for me, really, that I worry about.
So, Patrick, what's your, aside from the big tech here, what are there any themes that you're playing here in 2024 and beyond?
So we like the big cap tech. We like energy. Novo Nordisk, Eli Lilly. Those are the other market darlings that I still think make very
Okay,
good
so
sense.
you're right. All the good spots there. Tech and weight loss.
I can't say enough the value of talking to Patrick Armstrong. Look for his work, often quoted in essays in the Financial Times as well. Patrick Armstrong, thank you so much for Plurimi Wealth, their chief investment officer.
Societe Generale, great offices in Paris, man. I was there. Love those offices there. Subadra Rajappa joins us. She's head of U.S. rate strategy for Societe Generale, or as the old school, we call it SocGen. Subadra, what is our Federal Reserve going to do next? Because we've had some guests come in here the past couple of weeks, I would say, that say, you have, in your scenario analysis, you have to have a rate hike in your scenario analysis. I'm like, what? A rate hike? I'm just like, when are they cutting and how fast can they cut? Is there a scenario where maybe they think about pushing rates up a little bit?
I don't see that scenario, at least as of now. Perhaps the off chance that we see a sharp rise in geopolitical risks leading to supply chain disruptions and the economy remaining resilient under the circumstances could argue for a policy adjustment. But really, everything we've heard from our Fed speakers so far has been that yields have peaked.
Yep.
So we're looking towards perhaps, if anything, if the economy remains strong and resilient, that they might cut rates later than the market expects.
Okay.
And less than the market expects, but not necessarily hike from here on.
For better or worse, it's a presidential year. How does that factor into kind of the Fed's behavior, do you think? A lot of folks are saying they probably got to do something no later than June because you don't want it to feel like you're starting a rate cutting cycle in an election period, I guess.
So Powell has told us that they're not partisan in any way. They're not focused on the political scenario, and they tend to do what's right for the economy, and I do believe them in that. But that said, there is no precedence for the Fed cutting rates or adjusting policy just before an election. Right. So in some respects, that argues for perhaps a May or June rate cut, kind of get that process started, even though if they don't deliver on subsequent meetings, I think that they might space out cuts, but I don't think they'd take it all the way to November to cut rates.
I want you to overlay your world into the equity melt-up we're seeing right now. Lotfi from Goldman Sachs was just on, and he made very clear it's an economics call, a productivity call, better economy, up everything goes. Do you buy that? How do you link fixed income into the equity melt-up we're living?
The equity melt-up and the strength in the economy has definitely caught everybody by surprise. We have very strong growth momentum going into the second half of last year. And the momentum in the first quarter is also very strong.
So to get ahead of this, because of time, because Paul wants to jump in here, what's it mean in the fixed income space? What do CFOs do? Are we going to have an issuance frenzy because times are good?
We've already seen a little bit of an issuance frenzy in the first month of the year, and that's carrying over into February with 10-year yields coming from, say, 5% last year to around 4.25% now. But broadly speaking, it is a buyer's market in bonds because yields are very attractive, whether it be in investment grade or high yield, as well as in treasuries. I mean, we get 2-year and 5-year bonds being issued this week, and you're going to see a pretty decent amount of demand from investors because of the higher interest rates that you can and yield that you can pick up.
So I'm looking at a 10-year, like 4.24% here. Are we going meaningfully higher here, or do you expect rates in the back half of this year to come down as we look at our yield curve?
I do expect rates to come down gradually during the course of this year. I think that 10-year yields around 4.25% is a buy, in my view.
Ooh, nice.
Investors are going to be looking at 2 years around 4.75 and 10s around 4.25 as a buying opportunity. And every time bonds sell off, I see the buy the dip mentality come in and put a cap on how high yields can rise. So that's our base case, and I think we think 10-year yields will probably decline to around 3.75 sometime in the middle of this year, and then perhaps start rising towards the end of the year again.
What does the 10-year real yield do with a 3.75 nominal yield? You take the nominal yield, folks, you subtract out Subadra's best guess on inflation, and that gives you the residual, the inflation-adjusted yield. What's that number? Can you get down to 2.00, 1.00?
So 10-year yields around 10-year real yields, I should say, around 2% or higher is again a buying opportunity over the long run because inflation expectations aren't really moving that much. 10-year break-evens have been anywhere between 2 and 2.5%.
Right. So you have a 3.75 nominal, right? You just said that.
Yeah.
Where does the 10-year real yield end up?
It's going to probably be about 2% lower from there. Given
Back
the fact
below
that
1.
Yeah.
This is really important, Paul, because you say to yourself, how do you get a roaring 20s like Ed Yardeni's talking about? That's precisely how you get there.
Yep, absolutely. So what is my Federal Reserve doing here with its balance sheet? Are they still tightening here? I don't hear as much about that these days.
So I think the Fed is going to want to continue to run off its balance sheet.
And is it like 60 billion a month or something?
60 billion, the runoffs are capped at 60 billion for treasuries.
Okay.
And I think that they're probably going to lower that cap sometime in the second half from 60 billion to 30 billion. But I think that they're going to want to continue to run off the balance sheet for the remainder of the year and perhaps into the early part of 2025. And that's really where we have a little bit of an out of consensus call because the Fed, I believe, is going to try to reduce its balance sheet as it's cutting rates, which it hasn't done in the past, because they want to right-size the balance sheet and get that liquidity or the excess liquidity in the system out of the system as they're unwinding their balance sheet.
So, I mean, a lot of folks feel like the Federal Reserve is already late to the game here. They should have been cutting rates like now, because if you look at the real-time data, inflation has in fact been beaten, and they should be cutting rates now. What do you think? What do you say to those folks?
The way I think the Fed looks at the markets is holistically. Inflation is one piece of the puzzle, yes. If you look at the 3-month and 6-month annualized rates in core PCE, it's around 2%.
Yep.
But growth has been extraordinarily resilient. They want to avoid what happened in the 70s and 80s where they cut rates prematurely and they saw a resurgence in inflation. So the Fed is very much focused on both the inflation dynamics as well as the growth dynamics. And as long as growth remains relatively strong, I think that they're going to hold out on cutting rates.
Yep. All right. Subadra, thank you so much for joining. Subadra Rajappa from Societe Generale giving us your thoughts on the rate outlook.
Your daily look at the front pages around the world. A zillion stories. She was in here early. She got in like at 6:50 or something to do this. The newspapers, Lisa, what do you got?
All right, the New York Times, this one really stood out to me. So they are reporting that unused money in college savings accounts can now go toward your child's retirement.
What?
So this really stood out to me because there are parents out there who don't open the 529 because they're worried that what if my child changes his mind? He decides not to go to college. What if they choose a more affordable school and you're left with this chunk of money? What if they get a scholarship and you're left with this chunk of money? What do you do with it without getting the taxes taken out of it? Because you get that, the taxes have to get taken out of it. So that's what they're saying. Sometimes you can pass it on to a sibling. For example, I'm doing that with my son. He decided to stop a little bit early, so that money is going to his sister. But some people don't have the siblings. So this new rule under a federal law, it allows up to $35,000 in a 529 account to be rolled over to a Roth retirement account for the beneficiary if certain conditions are met. One of them conditions, it has to be have been open for at least 15 years, that 529 account. No contributions or earnings from the past 5 years can be transferred. I mean, there's a few other rules in there, but it's opening a new conversation, a new...
The conversation, we don't have time for me to get up on a soapbox and go mental about this. This is the problem with ERISA back in 1974. Is the solution for legislators is complexity. It's simple. You put money aside for your kid, you're not going to use it, put it in the parent's retirement account because the parents can't afford to retire because they're raising the kids. That's a national issue that we have right now. Paul, help me here.
That's the first thing I thought of. Was like, hey, if the kids aren't going to use it, I'm taking it back.
Yeah.
But I don't
take it back.
Now I have to pay the tax.
But now you got to pay the tax.
Okay, well, you do a Roth or whatever, but... Roger Ferguson is expert on this at TIA Craft, the former vice chairman. Make it simple. And they refuse to do that because they're afraid Paul Sweeney's going to get away with murder.
Exactly.
That's all there is to it. Next.
Okay. This is about the housing market. So a lot of renters, what they're starting to do is they're realizing that they might not be able to buy a house. So what they're doing is they're saying, you know what, I'm going to give up on my deposit and I'm going to make this apartment for me. I'm going to paint it. I'm going to wallpaper it. I'm going to decorate it. I'm going to hang pictures and, nail things in the wall, and forge over that deposit because they just realize that it's not going to be a reality for them. They're not going to be able to get that house that they want.
Yeah, with interest rates where they are. I mean, and there's just no housing stock for sale. So even if I wanted to move into something, there's not a lot out there.
I just looked in Skinny Atlas. We had Eric Friedman with us this morning, who lives in arguably the most beautiful town in all of New York State. And there's nothing for sale.
No.
I mean, I looked on Realtor, I looked on Zillow to talk to Eric about it, and there was no property to talk to him about. Because literally, Paul, nothing's for sale.
Yeah, well, there were open houses this week. In the town I live in, there were open houses this weekend, and there were lines. We had to wait because we're renting right now, and we're waiting to buy.
Okay.
And there were lines out the door at these open houses. So, because there's so few of them.
Yep.
It's true.
All right.
All right, Apple, they want to make more wearable devices to attract customers. Okay, so here we go. What do we got?
Does Gurman pay you to do this?
No, this is a Gurman. Yes, Mark Gurman. Okay, he says, wearable devices. Okay, they want to, Apple wants to keep their Apple family. They want to keep people locked in there. So they're talking about a smart ring that could take health tracking features from the Apple Watch and apps on the phone and phone calls and things like that. So the smart ring, why people will like it is because sometimes you have the watch and you might not want all the additional things. You might just want to know the health benefits. So you might not want the watch. So maybe this ring could be something that you could use.
Nope.
Nope.
Nope. That's a hard no.
Okay,
sorry,
how about
Tim
this
Cook.
one?
Sorry,
how about
Tim
this
Cook.
one? Smart glasses. It's something similar to new products from Meta, Amazon. They could provide audio, so you don't have to do the AirPods.
Which don't stay in my ears anyway.
Which don't. Yes, that's my biggest problem with them. And they use AI cameras. They can identify things around the world. So it's taking Apple that step closer to the reality spectacles that you can wear all day. Right. So that's another thing. The regular glasses, not the Vision Pro, but the regular glasses.
Lisa Mateo with our newspaper report today. Thank you so much. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.